Did you know Warren Buffett is currently sitting on over $325 billion in cash? Let that sink in. The greatest investor of all time, the man who built his fortune by buying when others were panicking, is holding more cash than the GDP of entire countries. And he's not buying anything. For 8 straight quarters, he's been a net seller. He even dumped over $100 billion worth of Apple stock in 2024 alone. The last time Buffett held this much cash relative to his portfolio size was in 2008. We all remember what happened next, right? But here's what should really grab your attention. This time is different. Not in the usual, don't worry, it's fine kind of way. It is different in a way that suggests what is coming could make 2008 look like a practice run. That's because we're no longer in stage 1 or stage 2 of a classic collapse pattern. We're in stage 5. And if you understand what that means, you have maybe 12 to 18 months to prepare. Stay with me, because I'm going to show you the exact 7-stage pattern that S played out in every major economic collapse in history. Spain in the 1600s, Britain in the 1940s, the Soviet Union in 1991. The United States is following the same script, almost to the letter. Before we dive into Buffett's warning, you need to understand this framework. Because once you see this pattern, you'll never look at the news the same way again. Every single reserve currency in history has collapsed. Not some of them, all of them. The average lifespan is about 94 years. The US dollar became the world's reserve currency in 1944 at Bretton Woods. From 1944 to 2024. That's 80 years. We're right on schedule, but this isn't random. It follows a predictable 7-stage pattern. Let me walk you through it. Stage 1, the golden age. This is when a currency is backed by something real gold, silver, productivity. For the US, this was from 1944 to 1971. The dollar was backed by gold at $35 an ounce. Other countries could trade their dollars for gold whenever they wanted. This created trust, stability, and real value. Stage 2, the temptation. The government realizes it can print more money than it has gold to back it up. For a while, nobody notices. You can fund wars, social programs, and infrastructure, all without raising taxes. It feels like free money. For the US, this was the late 1960s. We were printing dollars to fund the Vietnam War and domestic programs at the same time. Other countries started to notice. France even sent warships to New York to collect their gold in 1965. Stage 3, the breaking point. This is a crucial date. August 15th, 1971. President Nixon closes the gold window. Suddenly, the dollar is no longer backed by anything except trust in the US government. We transitioned to a pure fiat system. This is where the acceleration really begins. Stage 4, the illusion of prosperity. This is the most dangerous stage, because for a few decades, it actually seems to work. Think about the 1980s, 90, ESSI, and 2000s. America dominated, technology advanced, markets soared, and credit expanded. But underneath it all, the math was breaking down. Debt grew exponentially while productivity stagnated and real wages flatlined. The wealth gap exploded, but cheap credit and massive asset bubbles masked the decay. Now, stage 5, the desperation. This is where it gets really interesting, and it's where we are right now. Stage 5 is when the government knows the system is breaking, but they can't admit it. So they do 3 things simultaneously. First, they accelerate money printing to levels that would have been unthinkable just a few years ago. Over $4.5 trillion were created since 2020 alone. That's 20% of all US dollars ever created, printed in just 4 years. Second, they manipulate statistics to hide the real damage. Inflation calculations are changed, the definition of unemployment shifts, and GDP numbers are constantly revised. They paint a prettier picture than reality. And third, they start attacking their own currency's competitors. This part is critical. When a reserve currency enters stage 5, the government begins to see alternative stores of value as threats. And this is exactly why Buffett's massive cash position matters so much more now than it did in 2008. Because stage 5 doesn't just end with a market crash. It ends with a currency crisis. Stage 6 is the crisis itself. And I'll come back to that in a moment. Stage 7 is the reset. where a new system emerges, usually backed by hard assets again. We'll cover that at the end. Now, let's tie this back to Buffett. His $325 billion in cash isn't just about stocks being overvalued. He's preparing for something much, much bigger. Let's talk about the Buffett Indicator. Warren Buffett himself called it the best single measure of where valuations stand at any given moment. It is simple. You take the total value of the stock market and divide it by the GDP. Basically, are stocks worth more than the actual economy can support? A healthy level is around 80 to 100%. At 120%, Buffett starts to get worried. Back in 2000, right before the dot-com crash, the indicator hit 145%. In 2008, before the financial crisis, it hit 110%. What about today? Today, it's at 185%. Let me say that again. 185%. Stocks are currently valued at almost twice what the entire US economy can fundamentally support. But here's what most analysts are missing. The Buffett Indicator worked perfectly in 2000 and 2008 because those were stage 4 problems. They were stock market corrections, credit freezes, and bank failures. Yes, they were painful, but the system itself survived. The dollar remained the world's reserve currency. Treasury bonds were still the ultimate safe haven. The Federal Reserve could print money and patch things up. Stage 5 is different because when the crash comes this time, the traditional tools won't work. The problem isn't just a bubble in stocks or housing. The problem is with the currency itself. When the foundation is cracked, you can't just repaint the walls. This isn't just another recession we're talking about. It's the end of an 80-year cycle for the US dollar. And Warren Buffett, by hoarding cash and selling assets, is sending the clearest signal possible. He's not waiting for the storm. He's building his ark. Understanding this 7-stage pattern is the key to seeing what's truly happening behind the headlines. It's not about predicting the exact day, but about understanding the season we're in. And right now, it looks like winter's coming. Thanks for watching, and be sure to subscribe for more insights on how to navigate these changing times. Why is this time different? Everyone asks that question before a crash. And more importantly, I'm going to show you how the world's smartest investors are preparing for it, move by move. Forget the talking heads on TV. We're going to follow the money. First, let's look at the 4 differences that change everything. Difference number 1, debt levels. In 2008, the total US debt was about $10 trillion. Today, it's a staggering $36 trillion. That's a 260% increase in just 16 years. But here's the scary part. Over that same period, GDP only grew by 85%. We're adding debt more than twice as fast as our economy is growing. This is the mathematical definition of a Ponzi scheme. Back in 2008, the Fed had room to maneuver. They dropped interest rates from over 5% all the way to 0 to stabilize the system. Today, rates are already high, and we can just drop them to 0 again without basically admitting we're in a depression. Even worse, at our current debt levels, every 1% rate cut costs the government $360 billion in lost revenue. We are trapped. Difference number 2, the dollar's global standing. In 2008, there was no real alternative to the US dollar. When the world panicked, everyone rushed into US Treasury bonds for safety. China, Russia, everyone held them. Fast forward to today, the BRICS nations are actively building their own payment systems. Saudi Arabia is now accepting Chinese yuan for its oil. Central banks around the globe are buying gold at the fastest pace since 1950. Since 2018. Russia and China have slashed their holdings of US treasuries by over 65%. The dollar is still dominant, yes, but the fire exits are being built. When the next crash comes, international capital won't automatically flood into US bonds like it did in 2008. This time, it might flow out. Difference number 3 is social cohesion. Back in 2008, people were angry at the banks. Sure, but there was still a basic level of trust in our institutions. Congress passed the TARP bailout. The Fed started quantitative easing. People grumbled, but they ultimately went along with it. Today, that trust has evaporated. Congress has an approval rating of just 18%. Trust in the media is at 32%. And trust in the Federal Reserve itself, it's below 50%. When the next crisis hits and the government needs to pass another massive bailout, will the public accept it, or will we see the kind of social unrest that marks the final stages of a declining empire? And that brings us to difference number 4, the everything bubble. The year 2000 was a tech bubble. 2008 was a housing bubble. This time, it's an everything bubble. Stocks, bonds, real estate, crypto, private equity, fine art, even classic cars. Everything is overvalued at the same time. So when this bubble pops, where does capital go to find safety? In 2000, you could hide in real estate. In 2008, you could hide in treasury bonds. This time, there's no obvious escape pod, except for one thing, cash. And that is exactly what Warren Buffett is holding. Now, let's watch what happens next. Because Buffett isn't just sitting on a pile of cash for no reason. He's following a very specific playbook, and you can see it plain as day in the numbers. Let's look at his actual moves. Not what he says in interviews, but what he actually does with his money. Move number 1. He's selling his highest quality assets. In 2024, Buffett sold a huge chunk of his Apple stock. Apple, the company he himself called one of the greatest businesses in the world. He didn't sell because Apple suddenly became a bad company. He sold because at a certain price, even the best business becomes a bad investment. Apple is trading at 32 times its earnings. Its historical average is closer to 15. He is selling quality assets at bubble prices. Move number 2. He is avoiding entire sectors of the economy. Look at what his company, Berkshire Hathaway, is not buying. You see almost no new tech stocks, no speculative growth companies, no regional banks, and definitely no commercial real estate. That last one is particularly telling. Defaults on commercial real estate loans are up 300% year over year. Office vacancy rates in major cities are hitting 25 to 35%. Banks are on the hook for $2.9 trillion in these loans. If property values drop by just 30%, that blows a $900 billion hole in the banking system. Buffett sees this train coming down the tracks, and he is staying completely clear. Move number 3. And this is the part most people are getting wrong. He's positioning for deflation, not inflation. Everyone is worried about rising prices. Buffett is preparing for falling prices. Cash loses value during inflation. That's true. But during deflation, cash is king. Why? Because asset prices collapse, but the value of your cash stays stable or even goes up. Think about the Great Depression in the 1930s. Prices fell by 30%. If you were holding cash, you could suddenly buy assets for pennies on the dollar. Buffett has studied the Depression obsessively. He knows this pattern. The cycle ends with a deflationary crash first, and only then comes the currency crisis and high inflation. But deflation comes first. Move number 4. He's buying short-term treasuries. Berkshire's mountain of cash isn't just sitting in a checking account. It's invested in 3-month and 6-month treasury bills. Why short-term? Because it keeps him liquid and mobile. If interest rates suddenly spike, or if a credit crisis hits, he can get his money back almost instantly, ready to deploy. And move number 5. He is matching his 2008 patterns exactly. Let me show you a direct comparison. In 2008, just before the crash, Berkshire's cash as a percentage of its assets was 28%. Today, it's 27%. In the run-up to 2008, Berkshire was a net seller of stocks for 6 straight quarters. In the run-up to today, they've been a net seller for 8 straight quarters. In 2008, Buffett was 78 years old. Today, he's 94. He's older, he's seen more of these cycles, and he is acting even more cautiously now than he did right before the worst financial crisis of our lifetimes. Just think about what that means. What's really fascinating is that Buffett doesn't try to time the market perfectly. He doesn't wait to sell at the absolute top. He positions himself about 12 to 80 months before he believes the crisis will hit. In early 2007, he started raising cash. The crash came in late 2008. He started aggressively raising cash in 2023. You can do the math. But it's not just Buffett. And this is the part that should make your blood run cold. Corporate insiders are selling their own company's stock at levels we haven't seen since. You guessed it. Dois mil e sete. Look at the big names. Jeff Bezos sold $8.5 billion of Amazon stock this year. Mark Zuckerberg sold over $2 billion of Meta. And then there's Jamie Dimon, the CEO of America's largest bank, JP Morgan. For the first time in his 18 years as COO, he sold his own company's stock. When a man who has been bullish through every single crisis decides it's time to sell, you need to pay attention. These people aren't selling to buy a new yacht. They are selling because they see the numbers. They see the revenue slowing, the debt piling up, and the credit quality deteriorating. They're selling because they know what's coming. The pieces are all on the board. The smartest money in the world is getting out of the market and preparing for a storm. If this video was valuable, hit that subscribe button. I don't do clickbait. I don't do hype, just data, patterns, and analysis. Leave a comment below. Are you raising cash right now, or are you staying fully invested? I'm genuinely curious where people stand. And hit that like button if you want YouTube to show this to more people. Thanks for watching, and I'll see you in the next one.